Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook and your host here for about the next 15 minutes. We got a short and sweet show here on Options Guide TV. I'm going to look at one more trade. I'm going to go back to the well again. I got to be blunt, this week hasn't been good as far as earnings plays are concerned. And but I'm feeling a little better about this next one that I'm going to look at. The Amazon trade was probably the one trade that I thought might pan out this week. And once again, whenever you're doing earnings trades, you always want to I watch the number of contracts that you're doing. But in Amazon, and let's start by running the Tradier Pro software right now. They announced earnings after the close yesterday, and the market is down about 3.7%. Once again, it was all about the comments after the earnings report. They had a very, very solid earnings report, just like Google did. But they said something to upset the markets afterwards. And actually, it's fairly important. It's going to set the stage, I think, for the retail earnings that are coming soon. But they're anticipating a slowdown as far as their retail earnings space. Now, Amazon Web Services is still rocking and rolling. Google came out, had really good numbers. They actually said that in the cloud space that some of their issues was not enough capacity. And that kind of scared the market a little bit. But the biggest thing with Google this week that happened was they said they were going to spend $75 billion or around $75 billion on AI. And for some reason that made the market tank after the DeepSeek news. And Google is still struggling. It's down 3% today, right along with Amazon. So Amazon came down because of the Google news, and now Google is down because of the Amazon news. And it's been a real tough marketplace. News has really been driving the markets with the new administration, all the different headlines that are going on there. And then you throw in solid numbers. I think in general, most of and we're probably through the bulk of the earnings. We got retail. There's a lot of retail earnings that are coming soon, but we already got financials, all the Meg 7. And the earnings in general, most of the companies beat this quarter. But the biggest one was Amazon saying that they're forecasting slower growth as far as retail space is concerned. And that's what's driving the market lower. But once again, this is a normal day for, this isn't down 3% isn't a ridiculous amount in Amazon, but it's not going to work out for our butterfly because we did a one-day butterfly trade. So I'll toss it up there. Amazon did start out a little bit up on the day, for a minute or two. So if you might have salvaged it, I would have got out right on the open if I had the position on, which I actually intended to put on, and I literally just forgot to do it at the end of the day yesterday. Thank goodness in my world. 235.47 is where we're at. So the market was $235.47. We went and bought the 247.50s. 247.50s. There's still something in it. We bought. We're in the wrong expiration. That's why there's something in it. 247.50s. Yeah, there's nothing left. So this is the one that we bought. We sold the 257.50s. Right here, we sold these two. And we went out and bought the 262.50s, and we bought this one. So there's nothing left in that trade at this point in time. Let me get rid of that. There we go. And looking for a little bit of a pop up. The stock was at 235 at that point in time. Stock was there. Needed a little bit of a move up to the 247 level, which was within the expected move, which is $9 at this point in time. So if we would have got the move to the upside, this trade would have been profitable. That's what our goal was. Have somewhere between a 9. I think the maximum was like 16. So somewhere that we're planning that it would land right around the 255 level. If you look at Wednesday show. That trade did not pan out. I actually tried to look at a skip strike butterfly and it didn't really work out, but it's looking a little bit more interesting in the second stock that I want to talk about today, and that's McDonald's. So the downside of the McDonald's trade is that they are going to announce on Monday, and you have all week for the trade to play out. I like the scenario with Amazon where they announced on Thursday, and you basically had one day for the trade to play out. So we're going to look at McDonald's, and probably because we have a little bit more time, we can get it done for a decent net credit to the account. So this is going to be the paper trade for the day, and I'm just going to leave it at that. We got a Monday show coming up, and we have a little thing called the Super Bowl this weekend. So on Monday morning, McDonald's will be announcing earnings. So we will know the answer to our trade by the time we kick off the show for Options Guy TV at 11 a.m. Eastern time on Monday. So I already put the trade inside the what if calculator. And here's where the underlying stock is at 294.81 is where the market is at. The trades that I'm anticipating to do, and I'll pull this up, make it a little closer here, is we want to buy the 305 strike, sell 2 of the 307.50 strike calls, and then we want to buy 1 of the 312.50 strike calls. So this I can get done for a decent net credit to the account. And if I can get the box to check, there we go. Then I'll send it to the trade ticket. And when I started the show, it was trading right around 40 cents. And I think we just froze. Of course, here we go. All right, now it's 13 cents net. Where did the stock go on me? Let's go back and take a peek at it. Now it's flat on the trade. All right, the market's at 294.92. So the stock just literally just jumped on oh no, there it is. Okay, so here we are. But the stock is up. Yeah. So I think we got to adjust it. Want to get this done for a net credit to the account if we can. So this is $2.55. Delta here is 24. Okay, so let's adjust this trade a little bit. And this is going to be the official paper trade. We're looking at 305 was our starting point. Well, if I look at the earnings just in general, if we buy the long straddle, 295, we pay 550 and we pay 550, so that's $11. So 295 plus $11 is 290 or is 306, which gets us to this strike price. And that's ideally what we would like it to do if the market does move with us. But if the market goes down, we're going to do this for a decent net credit to the account. Our risk is if it blows away and goes more than a 1 standard deviation move, all the way up here, the highest delta, this one strike here is a 10 delta, saying there's a 10% chance that by the February 14th expiration, the underlying stock could finish 1 cent in the money based off of that information. So let's clear this out. Yeah, let's just clear it out instead of trying to adjust it. And we're going to buy, got to go up 2.5 points because the market has moved on us already. And we're going to sell that, skip this, and buy this. And now we're at a 12-cent net credit. Really like that to be 20. Well, I think we ride with it. We're at, the delta is 18 on the one that we're buying. One that we're selling, we're at 13. And we're doing it for a net credit to the account. Now, I'm going to go through the steps of how the skip strike butterfly works relative to a standard butterfly. And what we're really doing is we're selling a call spread that is going to pay for the butterfly. And if you were to just sell a call spread outright, you have from here, you have 36 cents to 54 cents, because this is the strike that you would be selling. And you're bringing in a smaller dollar amount here. The difference between the strikes just going bid to bid, you're talking about 20 cents approximately, and 18 cents to be more accurate. And that actually is used to pay for the actual butterfly. So if you were just doing this trade outright and you were just going to sell a short call spread to get bearish on the underlying, you'd be looking to bring in about 18 cents. Now we can do this whole butterfly and get this done for a net credit of, well, now it's 6 cents. Really want to get 11 cents. Ideally, what I would do is I would put this trade in for a net credit of 15 cents and I would let it ride. But the market was not as beautiful as it was when I first got on this morning. And it's all over the place. Now it's even. My gosh. And it doesn't feel like the stock is really moving. 294.91. All right, we can try moving it up a little bit more. I don't think that's going to work much. Okay, let's go to the 310. 310, this is 55. That's okay. Let's hit the 310. Sell the 55 twice, skip this, and buy this. 4 cents. All right, then you know what I think I may do? Let's try going. I don't want to have that type of risk getting this close, but let me just look at what this one is at. Let's look at we're going to sell the 350, the 302.50. We're going to buy the 305, skip the 10, and buy this one. That's a bigger debit. All right, well, I'm going to roll with this. Here's the trade that we're going to look at. We're going to go right at the 18 strike. This is the 122, 139. So we're going to buy the 307. We're going to sell 2 of the 310s, skip the 312s, and buy the 315. And if we do that, we got a net credit of 7 cents, and that's where it's going to be at. We're going to make that the official paper trade for the day. And I'll talk about how the setup works in general for the trade. And I'm going to send this one to the what if calculator so that we have it. And here's what the skip strike butterfly will look like. If you put the trade on and the market goes down or stays flat, you'll make that 7 cents. So if you do a few of these, because the maximum requirement here is $2.50. So you could do 3 or 4 of them if you'd like. And your max risk would be if the market blew through your short strike and went all the way down to the 315 level. That's where your max risk would be on this trade. And from 315 on up, you have known risk. So for every 1x, 2x1 butterfly that you put on, you will have a $2.50 worth of margin requirement. Now, if the market lands right here, you could potentially make $2.50. But I always like to sell these trades as we are selling a short spread to pay for the butterfly. The butterfly is our protection on this trade. If the market heads down, no big deal. We didn't lose any money. There's the 13. I like that way better right there. 15 cents. So I feel like we could fill this at 15 cents, but we'll have to, I don't know. I would have to send it to the floor and see where we're at. But if I look at this trade and we have this on, this is only 2.5 points wide. So if the market does move against us and we do have a few days to the expiration date, it doesn't reward us right away. We need some time decay on our 310 option contract. But if we just did a short spread, well, it would hurt us too in that scenario. So here's the way let's back out and let's look at the setup of the trade inside the options playbook. So if I run over to the options playbook and I pull that up, and we look at a skip strike butterfly with calls, this looks very similar to the options profit and loss graph that I just showed you, right? So the market is down here. This is strike B. You want it, you would ideally like it to finish there, but if it goes this way, no worries, because we're above the zero line. We get it done for a net credit. It blows through the strike. This is a strike that we skip on the standard butterfly and goes all the way to strike D. So if you did the standard butterfly, right, you don't skip that strike. If you do this one, you skip the strike. Standard butterfly, you don't. Now, by skipping the strike, what you're doing is you're embedding a short spread in. So basically, by not buying and selling that strike, by just skipping it, what you're doing is you're selling this short spread to pay for this butterfly. So you're selling strike C and buying, well, in this instance, would be strike B, but you're selling strike C and buying strike D. And that net credit received actually pays for the butterfly. So the alternative trade, to me, it's not that this is an alternative to a butterfly. To me, this is an alternative to a short call spread. So if I run in and I look at the short call spread and pull that up real quick, like here is that trade. This is the butterfly, 307.50, 310, 312.50, 1, 2, 3. That would be the standard butterfly. Now, if we get rid of these two legs, our short spread would be selling this one and buying that trade, bringing in a net credit of 19 cents at this point in time. So the butterfly's got to be really cheap, mainly because if this is a credit of 19 cents, then that is paying for our butterfly. So our butterfly is going to be like 5 cents, only because it's probably just so not wide, if you will. So we can go in, we can do this, and the butterfly would then be, we buy this one, sell 2 of these, and buy 1 of those. 13 cents at this point in time. So that's where the butterfly is trading at. So we're going to sell this spread to pay for that butterfly. And it looks like we get it done somewhere around 13 to 14 cents in general. The other alternative to doing this would be, I'm going to keep it there. That's going to be our trade for the day. I'm going to watch that one on Monday. But let me screw around with this for a second. Let's look at buying this option contract, and I want to go a little bit further out. And if I sell 2 of these, we got to sell this one. We don't really have a choice. And if we add some risk to it, we come down, we'd have to add a lot of risk. Throw 310 would put 10 points in. Yeah, I don't necessarily want to do that. Then we could get it done for a net credit of 32 cents. So if we go a little bit wider on it, and we paid less for our protection, this means that in this instance, we'd have $500, because this is the strike that we'd basically be skipping here, right in the middle, right around 315. That's a viable solution. And then you're bringing in a 40-cent net credit to the account, and that's not too shabby. The maximum risk then, let's look at this and send it to the what if calculator. Max risk based off of a 36-cent net credit would be $750 on the trade. So you would add you'd add $500 approximately in risk to the trade. The stock would have to blow through the strike and go beyond, and then you'd get a decent net credit to the account. It's medium. It's medium. It looked a lot more interesting this morning. I'm still going to keep it on. I think I'm going to keep it on the way that it was, mainly because I don't want to introduce too much risk onto the trade. So this will be the official skip strike butterfly. Man, the prices are all over the place on this. And let's send that to the trade ticket. Now it's at 16 cents. And that's not bad at all on a 2.5 point wide one. 21 cents. Now where's the market at? Oh, it's up 93. That looks enticing right there. I like that trade. That's a trade I get it done for 24 cents, and you are 5 points wide here, 2.5 points wide there. Now it's down to 3 cents. Wow, it's all over the place. I don't know what to say. Markets are live. They're moving. There's obviously a lot of fluff a little bit in the bid-ask spreads between the two, and it's really messing with where the midpoint is at. I do think you could get it done for 15 cents. So I'm going to leave it at 15 cents right now. If you can do better, if you can get somewhere close to this 20-cent net credit to the account, hats off. I think we could fill it for 15 cents. If this wasn't a fake account, I would send money. I'd send it in right now and just see if we could fill it at that level. But this is going to be the official paper trade for the day. So let me read it back. McDonald's is at 259.17. We're going to go out to, looks like the 25 delta. We're going to be buying the 305 strike call with the February 14th expiration. We're going to be selling 2 of the 307.50 strike calls. We're going to skip the 310 call and then buy the 312 call, 312.50 call. And in this instance, our maximum risk on the trade would be the $2.50 minus the 15 cents that we executed the trade for. That leaves $2.35 as our max risk. And that only occurs if the stock blows up and goes beyond the 310 level at the expiration date on February 14th. To start with, if the market does go down, we're fine. If the market kind of goes up, we're fine. If the market lands, luckily, between 305 and 307, then we're better than fine. We just can't let it go beyond the 310 level. So if you put this trade on, and anytime during the week, anytime during the 7 days until that expiration, it hits 307.50, just get out of the trade. You might be down on the trade if it happens on Tuesday. You might be up on the trade if it happens on Thursday. But I don't want you to get to the max risk scenario. So if I do this trade, my anticipation is that I'm going to make at least the 15 cents. If the market, the one real bad scenario would be that McDonald's would announce earnings and the company would blow up, and you'd wake up on Monday morning with the market starting at 315, more than a 1 standard deviation move. And that would be your worst case scenario, because then you could not trade out of the position and try to manage your risk. If you have any questions, please let me know. Please do put them in the chat box. And yeah, apologize for the market's movement, but now it's staying pretty steady right there. So I'm pretty sure we could fill right at that level. And thanks for stopping in. We'll be back on Monday. Have a very joyous Super Bowl weekend. I don't know who you're going to be rooting for out there, but may the best team win. Let's put it that way. And we'll see you Monday morning at 11 a.m. Eastern time for the next edition of Options Guide TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.